Hello, everyone. My name is, oh, sorry. I'm going to take that away from you for just 1 second. Hello, everyone. My name is William Mucker. I'm a client executive with Camaplan, and I would like to thank you all for joining us for today's webinar, Hedging Inflation with a Rental Workforce Housing Strategy, with Bill Green, co-CEO of Ginkgo Residential, and Sam Soley, Director of Investor Relations of Ginkgo Residential. As a quick note, please be aware that Bill and Sam will be answering questions at the end of the presentation. However, feel free to use the Q&A function on your screen, not the chat, to pose your questions whenever they cross your mind. They will be saved and addressed once the presentation portion ends and the Q&A portion begins. Before we get started, we have a brief disclosure to go through. Everything presented in today's webinar is strictly for educational purposes. Camaplan is a neutral third-party administrator of IRAs. We are not attorneys, CPAs, or financial advisors. If it comes to a time where you need advice in any one of those fields, we highly recommend you consult with your team of professionals. We are more than happy to be a part of that dialogue with your team of professionals to make sure the investment process is quick and seamless. We do not sell any investments at Camaplan, nor do we endorse any product. We will never call you about the next best investment opportunity. We believe that you should always do your own due diligence before investing your money, whether it be your retirement funds or otherwise. Once you have found the investment that is right for you, we will help open your account, fund that account, and facilitate the transaction into that investment. Here is my contact information. If you or anyone that you know who you believe can benefit from the information presented today have any questions about what is discussed and how it applies to self-direction, please do not hesitate to contact me. I would be more than happy to help. And without further ado, I'll pass the controls over to you. If you guys would like to share your screen and start the presentation, feel free to do that now. If you're having any issues, just let me know. Perfect. Thank you.
Hi, this is Bill Green. I'm a principal at Ginkgo Residential and co-CEO.
Sorry, folks.
I think you would still want the audio on, but you might want to mute your mic.
Yeah.
I muted you on our end because we're getting a little bit of feedback. Sorry, everybody.
Sorry, just 1 second.
No problem. Just a little bit of technical difficulties. We'll straighten this out pretty shortly.
Hi, this is Bill Green. I'm a principal at Ginkgo Residential and the co-CEO of Ginkgo REIT. I've been here for approximately 10 years. Prior to Ginkgo, I worked in private equity for Starwood Capital. And before that, I ran the global real estate platform for Wachovia Securities. And before that, I ran the domestic commercial real estate securitization business for Bank of America.
My name is Sam Soley, and I am the Director of Investor Relations here at Ginkgo. I've been in the real estate industry for about 35 years in various capacities. Majority of that time has been in banking, for several large institutions. I've had management positions, been an appraiser, and have been around in a lot of different capacities over the years. I've been with Ginkgo for almost 4 years now, and very glad that you all could join us today. We're going to cover a few topics today that we think are relevant for anybody looking to make an investment in a REIT. We're starting with talking about the overall economic scene that we're in today, rising inflation and interest rates, possible signs of a recession. We'll talk about multifamily specifically and show how it compares to other real estate classes. Bill will get into why non-traded REITs are a very viable option today for investors. We believe the best option. And then talk a little bit about our offering specifically at Ginkgo REIT, and we'll open it up for Q&A at the end. So inflation, as we all know, is higher than a lot of people can remember. I'm old enough to remember some of what was happening in the 70s and 80s, the last time we were in an inflationary environment like we're in today. And that was 40 years ago. PPI today is around 8%. Consumer price index is above 6%. For several years, the Federal Reserve was targeting inflation at around 2%. In relative terms, today's inflation rates have jumped significantly in the past 12 months, and the Fed has aggressively raised short-term interest rates from effectively 0 to over 4% today in an effort to bring that inflation rate down. The market has responded to the higher short-term interest rates, and this is reflected in the long end of the interest rate curve. 10 and 30-year bond yields have increased pretty dramatically, and the 30-year mortgage rate has essentially doubled in the past year. At one point, it hit about 7%. It's come down a little bit, but still, double what it was a year ago. The unemployment rate has stayed low throughout, and still near historical lows, which is a good thing. Looking at this chart of historical inflation going back to the 1920s, you can see that in the early 70s, we started climbing a pretty steep curve. And as you can see at the far right, we have experienced a very sharp rise in these rates in the past year. Comparing yield rates for Fed funds, 15-year and 30-year mortgages, you can also see a sharp rise in the mortgage rates. People looking to buy a house focus primarily on what they can afford on a monthly basis. What they can afford is a function of what their monthly payment will be. And that monthly payment is made up of real estate taxes, insurance, and the mortgage payment. This doubling of mortgage rates over the past 12 months has dramatically reduced home affordability and taken many home buyers out of the market. This is a significant development for multifamily housing because many renters are saving up to buy their first home. When the possibility to purchase a home is taken out of reach, they remain renters and they keep the demand for rental apartments high. With the Fed raising rates on the short end and trying to bring down this inflation that's running a little bit hot right now, we find ourselves in a situation where short-term interest rates are higher than long-term interest rates. One of the most watched indicators that the market looks at is the spread between the 10-year and the 2-year treasury. When the economy is running normally and in some degree of growth mode, which we've had really since following the great financial crisis, 10-year interest rates are higher than short-term interest rates because they're reflecting the market's view of risk over time. The yield curve in those times is considered normal. This is shown on the chart as anything above the red line. When short-term rates are above longer-term rates, the yield curve is considered inverted. And every recession, with the exception of one since 1955, has followed right after the yield curve has inverted. And as you can see on this chart on the far right, we are below zero, which means we are inverted. And there's a high probability that we will experience some form of a recession in the near future. We can hope for a short and shallow one if it does come. In terms of a hedge against inflation, multifamily real estate has historically been a good place to be. In a period of inflation, costs are rising and you need a corresponding increase in income to stay above water. Residential rents have historically kept pace with and have actually increased ahead of the inflation rate by 1 or 2% over the past several decades. You can see this reflected in the chart with the green line of rents slightly above the trend of CPI inflation in gray. So what does this mean for multifamily real estate, or if you're considering making an investment in other income producing real estate? How do these factors typically affect these investments? We've put together a little table here of asset classes: lodging, which is hotels; mini storage, those temporary storage units that look like garages you see all over the place that people use when they don't have enough room in their homes; multifamily apartment buildings; industrial and warehouse; and then office and retail. And if you look at the standard lease terms in the second column, for each of those asset classes, we've ranked them from the shortest lease term to the longest. You lease a hotel room for a night at a time, and it doesn't get much shorter than that. Mini storage is typically monthly. Multifamily, typically annually, sometimes can go monthly. Industrial and warehouse, a little bit longer with a 3 to 5 year lease. These multi-year leases usually have a built-in rent bump or escalation tied to CPI or some other inflationary index. Office and retail, typically a little bit longer, anywhere from 3 to 5 years, up to 10 or 15, again with periodic rent escalations. In an inflationary environment, you want to be able to reprice your terms as often as possible. So on one hand, you would think that hotels would perform well in an inflationary environment because they can reset their prices daily. The problem is when you're in an inflationary or recessionary cycle, people tend to have less discretionary income to spend. They're not going to take the trips that they used to for fun. Businesses cut down on business travel. We saw that hugely with COVID. It really did a number on the hotel industry. Unless you had a hotel in a beach community or resort community, those tended to do a little bit better. Mini storage typically underperforms in an inflationary or recessionary cycle when home sales activity declines. And this is because one of the big uses of mini storage is people put everything in storage when they're moving, or they need to clear some of the clutter out of their house for showing for sale. Mini storage performance is somewhat correlated to the overall single family housing industry. Multifamily tends to outperform. It's repriced frequently because of the shorter lease terms, and everybody needs a place to live. It's not discretionary. Industrial and warehouse also tend to outperform. They performed very well during COVID as everybody was doing their online ordering, and the workspaces in industrial and warehouse facilities are spaced out. So that created some comfort for the workers. Office has not been such a good story, and typically isn't during inflationary periods. On top of that, it's still reeling from COVID and the work from home phenomenon that we've been experiencing. Typically in inflationary times, it lags simply because they cannot raise rents fast enough to keep pace with rising expenses. Same thing holds for retail. And retail has also been suffering for several years because of Amazon and other online selling options. And with that, I hope that gives you some background on factors in the economy affecting income producing real estate and multifamily in particular. I'm going to hand it back to Bill, who's going to go into some detail about REITs and about our own specific offering.
Thanks, Sam. When discussing investing in investment real estate, most investors typically cite two attractions: a tax-sheltered dividend and the potential for long-term gains. When pushed for a third reason, it is usually to get away from the craziness of the stock market, which is also known as volatility. Traded REITs trade on public or over-the-counter stock exchanges like all other stocks. The price can move surprisingly quickly, and intraday 1% changes in value are not uncommon. Non-traded REITs are purchased or redeemed from the issuer at prices established by the board of directors using a variety of valuation tools. Purchases and redemptions tend to move in periodic, daily, weekly, monthly, quarterly, annually adjustments, which telegraph to the market what the price is for the ensuing period. How are stocks priced in these two markets? Well, the publicly traded REITs trade in accordance with the public market fund flows on top of their own performance. Funds freely flow into the market overall represent over 50% of the performance, the beta of publicly traded REITs, which causes their values to deviate. Non-traded REITs trade closer to the intrinsic value of the underlying assets due to the price being established periodically by the board of directors. While each board relies on different consultants and differing methodologies to establish their stock price, the intent of the boards are the same, and that is to have the price of the stock represent the long-term liquidation value of the company's assets. Real estate assets adjust in value at a dramatically more measured pace than stock markets, interest rates, liquidity flows, and tax code changes. Why? Probably because investors in real estate take a longer-term view, typically 4 to 10 years. The investing market takes note. Only 8% of all commercial real estate is owned in public markets at the start of 2022. Public REIT prices can appear to be the tail that tries to wag the dog, but its volatility is a problem for what is fundamentally only an asset class election. Over the past 5 years, non-traded REIT stocks issuance has nearly matched the same for traded REIT stocks. Why has this flip happened? Many reasons, but lack of price volatility to the underlying asset is probably the main driver. Remember, non-traded REITs lengthen liquidity, but offer more stable pricing. Traded stock have minute-to-minute liquidity, but at a rapidly evolving price. Non-traded 2.0 is an interesting time. Many improvements and enhancements have occurred since the early days of non-traded REITs of the 1990s and early 2000s. We already mentioned volatility. Pricing of stock throughout the capital raise is another one. In the early days, the stock price was held constant for an offering period, typically 3 to 5 years, after which pricing changes may or may not occur. But when they did, they could be a large disconnect from the offering price, many times a price step down. Under the new regime, pricing occurs with frequency throughout the perpetual capital raise. The second is low fees. The broker-dealer played a large role in the early non-traded's history. Given its pioneering nature, this came at a heavy cost and capital came in great quantities, which the company had to typically sit on for the periods. Now, most non-traded REITs have a no or low load structure. Most of the dollars raised now go into the assets. In the early stages, only about 85% of the cash raised went into the assets due to the fee structure. The next is non-traded REITs are now recognized by clearing brokers. Non-traded REIT stocks are accepted subject to approval by Schwab, Fidelity, and other clearing brokers. Importantly, this allows financial advisors and registered investment advisors to keep the assets on their platform and provide a uniform statement to their clients. The next is larger companies are more diverse. The acceptance of non-traded as an asset class allows companies to grow to this size. This scale and diversity lowers event risk from any one asset, something the industry hasn't had until now. Redemption ability. In the early stages of non-traded REITs, an investor's liquidity was limited to a liquidation of the company's assets or its public listing, similar to a fund format. Now, in 2.0, liquidity is offered at all times, subject to certain limitations on the non-traded company. The perpetual nature of the capital raise allows the company to remain active in the market. Even with the much reported redemptions now taking place from many of the larger public non-traded REITs, the existing members are achieving their price, and the non-traded meet these redemptions by continuing to raise capital, sell assets, or take on surplus financing. Our strategy hasn't changed a whole lot over the past 30 years. We pursued this when we were public, when we were private, and now as a non-traded REIT again. We seek to provide the best quality workforce housing we can in communities where we strive to make the residents proud to call it home. How do we do it? We need to start with a cheap basis. We buy older assets that were often once located at the corner of Main and Main. These assets are typically already 30 to 50 years old, and we seek to preserve the communities with the common area, energy efficiency, and interior improvements that will extend the lives of the communities another 15 to 30 years. We cater to government workers, teachers, security personnel, retail workers, construction workers, service providers, medical staff positions, young adults, widowers, the newly single, and oftentimes the retirees. These comprise what we define as workforce housing. Our secret sauce? You end up with a 50% to 60% cost versus new construction and end up with 60% to 70% of the new rents. Some of this gain is eaten with higher operating expense ratios, but there is a surplus in this margin. We also believe in proximity. Everything we currently manage is within 3 hours of Charlotte, our headquarters. Most assets are within 1 mile of another Ginkgo asset. We believe in adjacencies, buying assets very close to assets we are succeeding with. That provides a labor and capital arbitrage for us. And we believe in scale. Even only in 2 states, the 7,000 apartments we represent have 1.5% of all of the apartments in the state of North and South Carolina. This is great scale, but it leaves us adequate room for growth. While we believe in our mission, our residents, and our 225 employees, we know we have to deliver to the investor. Throughout our prior periods of formation, private, public, private, with a series of LLCs, and now non-traded private REIT focused, we have always benchmarked ourselves. For Ginkgo REIT, we benchmark ourselves against both all equity and the equity apartment NAREIT indices. As discussed previously, 3 things to point out. 1, the moderate volatility of Ginkgo versus the volatility of these 2 indices. 2, the high correlation between the indices themselves. These are all very different companies and different sectors of real estate, which have huge differences between them in the private sector. But liquidity flows in the public market forces them all to the same basic outcome. These are all performing the same. Lastly, while investors say they want liquidity, they are generally more likely to use that liquidity poorly. The proverbial sell low and buy high. We capitulate to the market more times than not when we sell, and we jump on a rocket after it is taken off when we buy out of fear of losing out. That's what the data actually suggests. At the asset and portfolio level, we continue to see revenue gains that generally eclipse expense increases. In 2021, Ginkgo REIT same-store revenue and expenses were up over 9.5%. In 2022, through only 9 months, revenue was up 10% and expenses were up just 8%, producing a year-to-date 12% NOI growth. This growth is dramatically better than inflation. We could probably show this chart for any 2 years in our 30-plus year history, and while the magnitude might be different, the relationship would be the same. Rents exceed inflation in the multifamily industry. Our target markets of North Carolina and South Carolina have perennially been 2 of the top 10 growth and relocation states for over 30 years. That story continues to play out. Since 2000, over 40,000 people per year net relocate or net birth into the Charlotte MSA. And since 2000, over 30,000 people per year relocate into the Raleigh MSA. What is interesting, of the top 10 states, North Carolina and South Carolina and Arizona are the only states with state income tax. We gain workers, not retirees, which has a much greater impact on the economy. As an early stage REIT, we offer a great shelter, which will continue for the foreseeable future. Multifamily recurring capital improvements are oftentimes a series of smaller projects that allow for first-year write-off under the tax code. Our dividend has increased 26% over the past 3 years since formation. Cap rates have had value move up more than that to 45% over our original offering price. We do expect the dividend rate and the cap rate growth to probably converge in the next few years, and that is natural, particularly in a slightly rising interest rate environment. We have a unique hybrid strategy that benefits the investor. We own over 2,000 apartments wholly and directly in the REIT, plus we joint venture with outside limited partners on communities that own an additional 4,000 residential units. When assets have a capital need of more than 10% of our equity or have a more expansive post-closing capital plan, we typically share the risk with a joint venture partner. These capital plans that we're putting in here seek to extend the life of the community, upgrade the interiors and living conditions, and improve the quality of life. We typically earn a return equal to $1.50 to $2 for every dollar invested in these capital plans. If the joint venture returns exceed a hurdle return beyond a threshold, the limited partner's return after the hurdle gets paid in increasing percentages to the REIT. There is no double set of fees by the manager. These are net returns to the REIT. We don't know of another REIT that actually does this. Ginkgo Residential, your manager, is a vertically integrated organization. We are 225 employees with 175 on-site and 50 in the Charlotte corporate office or in regional offices. We are a licensed construction management firm under the banner Beloba Construction Management, and we are a licensed property manager, Ginkgo Residential. We are Ginkgo REIT's advisor and manager. Everything we do takes into consideration what is in it for the resident, the employee, and the investor. Our central ethos is to provide a warm, dry, safe, and affordable living environment for our residents, an upwardly mobile career path for our employees, and a return and a product you can be proud of for our investors. For the residents, we reduce energy consumption and water by submetering, utility consumption by insulation, air seal, and insulation, and by replacing all worn equipment with top Energy Star rated equipment. We enhance the structures in the grounds with attention to water flows, proper vegetation attention, and parking configurations. Longer-term residents generally enjoy lower rents when compared to new leasing rents, since they are a lower cost to us by staying longer. For the employees, all of our employees are awarded stock after the first 12 months, and we are generally their single largest investment. We collectively own over 30% of the stock in the company, which is more than $50 million of equity. 15% of our company has been employed with us for more than 10 years. For the investors, since rebooting the company in 2013 as a private investment vehicle, we have attracted over 250 discrete investors, many of whom who have invested with us more than 10 times. Nearly each of these investors has invested into Ginkgo REIT, with most dividend reinvesting. We protect their interests with a board that is a majority independent. Our business model requires this. These are all elements of ESG. We think we were ESG before ESG was cool. So thank you for your time today.
All right, perfect. Thank you for that presentation. So we can start the Q&A portion now. If anybody has any questions, I highly encourage you to put them in the Q&A box now. And we can get started. To start off, I understand you guys take IRA investors particularly. How has that process been for you? How do you like it? And what are your comments about that?
We've had IRA and SEP investors for probably 10 years in both the REIT and in prior transactions. They're typically self-directed IRAs. The process is basically the same. We get on the platform of the IRA provider, and once we're on the platform, they can actually take those self-directed accounts and open the accounts. After that, the flows, the information, everything works identically.
The majority of those accounts are actually with Cama. We've had a long-standing relationship with Cama, and that the process has gotten very smooth between us. So it's an easy process for investors.
Perfect. That's great to hear. Any due diligence that you would recommend people that are interested in investing in REITs, other than, you know, being knowledgeable about the structure itself?
I think it depends on the individual. A lot of our investors historically have been financially savvy, and a lot of them are in banking or real estate related fields, et cetera. But we're open to any number of inquiries, any amount of information that can be requested that we can provide. We will do so. We are not public, and so therefore we do have a flexibility to really try to answer questions in ways that a public company might be a little bit more restricted on.
Perfect. Thank you. Again, anybody have any questions, please feel free to use the Q&A function. We're a little bit slow today. Trying to think of any questions. Anything that wasn't addressed in your presentation that you'd like to add now?
Yeah, I think, you know, one of the things we didn't talk about our offering is kind of the mechanics of investing with us. We do closings once a month at the end of the month. It's a very straightforward process. We send out an offering memorandum. There's a subscription agreement that an investor takes about 5 minutes to fill out. They provide verification that they're an accredited investor and send in the money. So it's a pretty painless process. We have a pretty sophisticated investor portal that lets investors take a look at their statements and performance of their money, and other communications that we would have with the investors, including any tax forms or notifications. So I think we've got a great platform that fits investor needs very well, on top of the performance that we talked about, which is first and foremost for most people.
Absolutely.
Additionally, we're audited and tax return prepared by Grant Thornton. A lot of real estate, unfortunately, you do not get your tax information until well past the normal filing period. We strive to get everything done by March each year, so that people can file in the ordinary course. And it's 1099. It's a fairly straightforward process. If you're an IRA investor, it's obviously suitable under IRA. There's an exemption for REITs as an asset class in IRA accounts, and so it's really pretty straightforward.
Perfect. It seems like your presentation was so good that it answered all the questions that could be asked.
Yeah.
But this will be recorded and sent out and posted on social media for people to see. So if anybody has any questions watching this, not live, where can they find you?
www.ginkgo REIT, that's GINKGO REIT.com. Quite a bit of information there. The forum to get in touch with us, plenty of things to pull down the most recent performance statistics and things like that. And give us a call. We're happy to talk to anybody.
Amazing. Thank you. Thank you, Bill. Thank you, Sam, for your time and presenting this to us today. And I encourage you guys to reach out to Bill and Sam with any of your questions after the fact. And I hope you guys enjoy the rest of your day.
Thank you, William.
Thanks, William.
Thanks, everybody.